Obama, of course, State of the Union address completed this morning, and really a big focus on unemployment, also a very big focus on freezing public spend. But it does seem that there is quite a lot of political posturing, considering that he has lost a very key vote in Massachusetts.
Obviously, we are in an election year actually in the United States, in the sense that we've got some congressional elections towards the end of the year, and a lot of this State of the Union address obviously focused on that. And the big thing that people are focusing on in the US is the fact that unemployment's still at the 10% level. So unemployment, from a political point of view, a very big focus for him. The other thing that he needs to be saying is, I'm going to be very responsible in the long run with finances, given that he's actually spent quite a lot of money on getting healthcare fixed. Now, that's not been finally approved, but he wants to spend quite a lot of money on healthcare, so he needs to cut back on other expenditure.
Clearly, and also just keeping in mind that he is trying to freeze public spend for 3 years, apart from national security, obviously the medical side of the economy as well, and social security and pension as well. And he says he's already saved $20 billion by eliminating certain projects as well.
Obviously, you need to actually rein in spending, because his predecessor, George Bush, was actually quite a spendthrift, so there should be lots that can be cut back. What should also start becoming a bit cheaper is the whole Iraq story, but on the other hand, spending on Afghanistan going up at the same time, so not much to be saved there, I guess.
Vikus, there seems to be quite a big shift in focus this year. It's obviously about unemployment and also the country's debt levels. We only have to look to Greece to see what's going on there with the Greek government bonds, and a lot of talk about China going in and buying those bonds. Also Spain and Portugal in a similar situation. Japan's credit outlook downgraded to negative, and Standard & Poor basically saying that Japan needs to come out with a credible plan to try and rein in all the deficits that we've been seeing for many years. So where do you see the focus going this year? Do you think it is about the debt levels globally?
I think that there are certain serious concerns about the debt levels, because what has been happening is that interest rates haven't really risen as far as they normally would with the amount of bonds that's been issued, because of the very liquid monetary policy being run by the central banks. But as soon as the central banks start actually tightening things up, you could see interest rates on these bonds rising quite a lot. Now in Greece, we've seen these bond rates shoot up, so the margin between Greek rates and, let's say, German rates have become much larger in the last 2-3 weeks. So what we're seeing is that there's a big problem with the credibility of the Greek government in terms of the financial policy they're running, and you also have Spain in the background, which is also a major issue. And what seems to be happening is that those countries which had major debt problems, in the sense that they had too much private sector debt, like Ireland, Spain, Greece, England, of course, as well, or Britain, they seem to be having a major problem now with public debt, because they need to actually spend a lot of money to stimulate their economies. And the levels of debt that they're going to is very worrisome. And it's more worrisome in the case of someone like Greece and Spain, because they are members of the euro area, so they cannot deflate or they cannot actually use their currency to make any headway, and they can't print their own money. So some serious worries about especially Greece there.
Fed, we heard that they will be keeping the rates unchanged for an extended period of time. We know that inflation is creeping in, also in certain economies such as the UK, China as well, but we know China is reining back on some of the stimulus that we've been seeing for quite some time. Where do you see the inflation environment going globally, coupled with the interest rate environment? Because clearly now reserve banks are looking at not only the mandate of keeping inflation in check, but also considering growth and, of course, unemployment.
I think that what is happening at the moment is that you are seeing a lot of the quantitative easing that was out there being pulled back. So, for instance, the Federal Reserve announced that they will stop buying the debt of Freddie and Fannie Mae, or Freddie Mac and Fannie Mae, because of which are the major housing agencies in the US. So essentially, the Fed will stop pushing money into the system. That's one of the reasons why they've said they will keep interest rates low for an extended period of time, because they don't want bond rates to kick up too much when they actually eliminate that quantitative easing. So you're seeing the quantitative easing being taken out, but we don't really see interest rates actually rising before maybe the fourth quarter of this year.
Here in South Africa, interest rates kept unchanged at 7%. Inflation figures released yesterday were now above the target band of 3 to 6%. Currently, it's 6.3% for the month of December, from a rise of 5.8% year on year in November. Inflation clearly a problem right now, with rising food prices, oil prices, and clearly Eskom thrown in the works as well.
I think what's mainly driving the rise in inflation is the fact that a year ago petrol prices were significantly lower on a very low, which is the base effect. But the base effect says that, you know what, if petrol prices did go up in the last year. I'm not too impressed by the base effect story. But what happens is that we are coming in above target, which is one of the main reasons I think the Reserve Bank didn't cut rates. Interesting to hear from the new Governor of the Reserve Bank that there was some difference of opinion in the Monetary Policy Committee, and that there were actually voices for a lowering of interest rates. And the main reason why they want to lower interest rates is that we've still got very, very slow demand growth in the South African economy. We're struggling with demand, but at the same time, while inflation is above the target range, while the Eskom hike is looming, they felt it was irresponsible to cut rates. But in South Africa, there's really no prospect that we'll see rates rise this year.
Would you be jumping into equities right now, considering that there is so much uncertainty globally?
There's always uncertainty in equities, in the sense that if things are good, then the prices are high. So our main opinion about equities is that we don't think rates will rise at all in South Africa. So rates will stay low, and we think that companies will actually find ways to make more money as the economy starts picking up slowly. So we think that there's still significant upside in the equity market.